Hey traders, and thanks for joining another session of TLA. In this episode, we're going to explore one of the most crucial elements of profitable trading, the liquidity trading strategy. Whether you're new to trading or a seasoned pro, grasping and applying liquidity concepts is vital for steady gains in the financial markets. Join us as we break down the importance of liquidity zones and how they serve as major confluence points in shaping our trading choices. We'll reveal the impact of liquidity sweeps, how they offer crucial clues about market behavior, helping you gain an edge in your trading plans. So traders, if that sounds valuable to you, hit the like button to show your support and subscribe to our channel if you're new. Catch you right after the intro. Welcome back, traders. Now let's dive in. So what is the definition of liquidity? Liquidity simply means money or large counter orders that must be fulfilled. The market continually seeks to absorb this liquidity to generate momentum. Essentially, liquidity serves as the lifeblood of the market, playing a vital role in its overall dynamics and functioning. Where can liquidity be found in the market? Liquidity refers to a zone on the chart where a significant amount of capital is positioned, including stop losses and pending buy or sell orders. When a trader is stopped out of a trade, the market captures the funds linked to that stop loss. It's often suggested that central banks or major financial institutions might influence the market, crafting situations that mislead traders into thinking they fully grasp price action. To succeed and remain profitable, it's essential to recognize liquidity zones on the chart. These areas, where large volumes of orders accumulate, offer valuable insights into market behavior and help avoid major losses. Liquidity can be spotted in different areas on the price chart. Some examples are equal lows and swing lows. Liquidity often gathers just below prior equal lows or swing lows, as these zones tend to draw buying interest and lead to an accumulation of orders. Equal highs and swing highs, likewise, liquidity tends to appear above these levels, where selling pressure may build up. Dynamic trend lines and channels, liquidity zones may form above or below these boundaries, as retail traders often position their orders around these regions. Order blocks and order flow, regions with heavy executed orders or clusters of pending orders can function as liquidity zones. Support and resistance levels, price zones that have historically served as support or resistance often draw market participants, turning them into possible liquidity areas. Daily candles, body and shadow, liquidity may exist around the body or wick of daily candles, as these zones indicate price rejection and active trading behavior. Session highs and lows, peak and bottom levels of trading sessions can signal liquidity zones because of heightened trading volume and trader engagement. Fibonacci levels, many traders seek liquidity near key Fibonacci retracement or extension zones, as these are widely watched and actively traded. Now, let's move over to the live chart to examine some real examples of liquidity on the price chart. On the screen, we're looking at the 4-hour timeframe chart for the EUR-USD pair. Observing the left side of the chart, we notice a series of bullish structure breaks. It becomes easy to trace order flow and identify order blocks. Interestingly, the market did not react to the higher order blocks and order flow zones. Instead, price dropped quickly, sweeping the liquidity sitting below those levels by triggering stop losses from traders who had entered positions around those zones. Once enough liquidity was captured, the price used those upper levels as inducement points and reversed from the most extreme order block before making a sharp move upward. Following that, price action formed a tight internal consolidation. Within that range, we can clearly observe a short-term trend line forming, and at the base of the structure, we also spot equal lows, creating ideal liquidity zones both at the top and bottom of this range, where multiple pending buy, sell orders and adjusted stop losses are likely clustered. It's vital to always keep in mind the role of liquidity zones and price action. Markets are naturally drawn to these levels, and ignoring them can result in serious losses. Personally, I never place a trade without first spotting a liquidity sweep setup. For instance, as mentioned earlier, the reason for price rebounding from the extreme order block is the liquidity taken from beneath the prior order blocks and recent consolidation area. The market builds momentum by collecting liquidity and uses it as energy for a directional move. Here, we can observe how price took out liquidity under the equal lows with this large bearish candle. Upon reaching the order block, price quickly reversed and made a strong bullish move, targeting the buy side liquidity above. This reinforces the need to always recognize liquidity sweep structures before committing to trades. Now, on the chart, we can also identify a strong area that has acted both as support and resistance. This level has built up considerable liquidity just above it. Shifting focus slightly downward, we find a descending channel pattern. Liquidity has gathered both above and below this channel. After hitting the order block formed by a change of character wave, the price surged upward, clearing liquidity above the channel and triggering stop losses for traders in short positions. From there, price continued its upward path, sweeping the liquidity above the resistance zone, followed by a minor pullback, then resumed upward momentum to clear liquidity above this swing high. Now let's move on to how we can practically apply liquidity zones for trade setups in real market conditions. Before jumping into live chart analysis and real trade examples, let's take a moment to break down the foundational theory behind liquidity. Understanding this will give us the context needed to interpret price movement more accurately. Imagine a simplified structure that mimics price behavior. In this scenario, we're looking at an uptrend where the market is consistently breaking highs. The first step in building a trade setup is identifying the prevailing trend, in this case, bullish. Once we confirm an upward break of structure and a new swing high forms, we expect the market to pull back into a specific point of interest, often to fill inefficiencies left behind. However, before entering the position, one crucial confirmation is needed: a liquidity sweep. This signals that the market has absorbed enough liquidity and indicates strength in the demand zone. As discussed in earlier lessons, we always treat liquidity sweeps as a confluence factor for trade entries. Why is this so important? The core idea is that price needs liquidity to move. If a sweep doesn't happen before the price reaches a point of interest, there's a strong chance that area becomes liquidity itself, fuel for the next price leg, not a valid entry. In the current scenario, we observe a consolidation phase with equal lows forming beneath it. These equal lows represent resting liquidity, mostly stop losses from traders who went long too early, assuming the pullback was finished when it wasn't. Once the market sweeps this internal liquidity, we look for price to tap into a higher time frame demand zone. As price enters that key area, we zoom into the lower time frame to confirm a shift in market behavior, typically a change of character. We also mark out a new, more precise point of interest on the lower time frame. Once both confirmations are present, we look to enter a long position with our take profit level set at external liquidity, such as the previous swing high. In this example, once price tapped the zone and reversed, it left an imbalance behind and pushed up, forming an internal high followed by a shallow retracement. That was then followed by a sharp upward move breaking another structure. Now we have yet another bullish break and a newly formed demand zone associated with it, potentially our next area of interest. However, things can get tricky. We also see another unmitigated zone near the break of structure. This can easily confuse traders about which level to trust. As discussed in earlier episodes, this is where inducement comes into play. Inducement zones are crafted by institutions and smart money players like central banks to lure retail traders into premature entries. Here, the market created a misleading structure that tempted sellers to enter with stop losses placed above the internal high. But instead of dropping, price surged upward, breaking structure and invalidating what many would assume was a valid order block. This generated a false demand zone. Following that, price pulled back into what we now recognize as an inducement level. The brief upward movement afterward was fueled by retail traders going long from that zone, placing stop losses just beneath it. This collective action created a fresh liquidity pool directly under the inducement level. The market eventually swept that zone, confirming the setup. Once again, as price entered the higher time frame point of interest, we returned to the lower time frame to find a change of character and mark our new POI. When everything aligns, we execute a long trade, aiming for the external liquidity level, which also serves as our target zone. Now that we've covered the theoretical side of how liquidity can guide smarter trading decisions, let's shift to real chart examples. Observing these principles in action will give you more clarity on applying them to your own strategies. One last tip before we jump in: always backtest your setups. A solid rule of thumb is to backtest at least 100 trades before deploying a strategy in live markets. Why? Because win rates are influenced by multiple factors: market volatility, session timing, trader mindset, risk management, and the chosen timeframe. Without proper backtesting, even the best strategy can fail in real time. Live chart example: GBP, JPY, 15-minute time frame. Let's walk through a real-time trading scenario on the GBP, 15 Japanese yen minute chart, focusing on market structure, order blocks, and liquidity dynamics. 1. Overall market context. We start by identifying a clear bearish trend, characterized by a sequence of breaks of structure, BOSS, to the downside. This confirms that sellers are in control. After the mitigation of a prior order block, price aggressively dropped, forming two strong bearish candles, which also left behind a noticeable imbalance, price inefficiency. We mark the origin of this move as our new supply zone or order block. 2. Price retracement and liquidity setup. Price then begins a retracement, climbing back toward the supply zone. During this pullback, price forms a set of equal highs, just beneath our previously marked order block. This structure hints at a liquidity pool forming above those equal highs, likely composed of buy stops and breakout entries. This setup increases the likelihood that the market will sweep the liquidity before reacting from the supply zone. The liquidity here becomes the fuel for a potential bearish reversal, as discussed in our strategy. 3. Waiting for the liquidity sweep. At this point, we exercise patience. We want to see a clean sweep above the equal highs. Price tapping into our order block, which would act as a high probability reversal zone. This confluence of the liquidity grab plus return to supply gives us a strong case for a potential short entry. 4. Price reaches point of interest. As expected, the price spikes above the equal highs, grabs the liquidity, and taps into the highlighted supply zone, giving us the exact setup we were waiting for. With all confirmations now in place, this is where we start looking for execution. 5. Refining entry on the 1-minute chart. Now it's time to zoom into the 1-minute time frame. Here, we'll look for change of character, CHOCH, indicating the shift from bullish pullback to bearish intent. Possible entry triggers like internal BOSS, rejection wicks, or bearish engulfing candles. Once these are spotted, we'll be ready to execute the short trade with precision and tight risk control. Checkmark key takeaway. This trade setup demonstrates the power of combining market structure, order blocks, imbalance zones, and liquidity sweeps to frame high probability entries with confidence. 1-minute chart execution. Now let's dive into the 1-minute chart to fine-tune our entry execution for this setup. 1. Clear change of character, CHOCH. The chart shows a significant change of character as price breaks the previous structure to the downside. This shift signals that bearish momentum is stepping in. During this move, the market also leaves behind a clear imbalance, offering us an additional clue for a potential entry zone. 2. Identifying the order block and VSR pattern. We then highlight the order block that formed at the origin of this CHOCH. Additionally, a VSR, volume spike rejection, pattern is clearly visible here, indicating a strong rejection from the higher time frame supply zone. This further validates the bearish intent and increases the probability of the setup playing out in our favor. Checkmark this confluence strengthens our case for a short position. 3. Setting the entry and risk parameters. With our point of interest marked, we move to execution. A sell limit order is placed at the order block. Stop loss is positioned a few pips above the high of the zone. This allows us to manage risk precisely. Take profit is targeted at the 15-minute swing low, aligning with the overall bearish structure. 4. Trade execution and outcome. Once price taps into our zone, the sell limit order is triggered, and we're officially in the market. From this point, we monitor price action closely to ensure it aligns with our expectations. As anticipated, price reverses from our zone and trends downward, eventually hitting our take profit target. Bullseye. The trade closes with a 15R, reward to risk, ratio, making it a highly successful execution. 5. Final thoughts. While this setup played out perfectly, it's crucial to remember, not every trade will be this clean. Risk management and strict adherence to your trading plan are what truly lead to long-term success. Pond 1 Yen Hour Chart Analysis. On the 1-hour chart of Pond Yen, we observe that the price is in a clear uptrend, marked by a series of bullish breaks of structure, BOSS. Within this bullish context, two potential demand zones stand out, areas where price could reverse and continue the upward momentum. Which zone is safer to trade? The key question is, which zone offers a higher probability of success? As previously discussed, we only treat a zone as valid for trading if there has been a liquidity sweep above or below it. In this case, one of the zones is a decision order block but does not have a preceding liquidity sweep. Therefore, I do not consider this zone as a reliable point of interest. Instead, I view it as an inducement area, a zone that creates a liquidity pool beneath it. Focusing on zones confirmed by liquidity sweeps helps us align with market dynamics and reduce the risk of falling into false signals or traps. Price action and liquidity pools. Next, price makes a notable move downward after forming a new higher high. This is accompanied by a large red candle indicating strong selling pressure, which leaves behind a significant market inefficiency. Below the equal lows and the inducement demand zone, there is a substantial liquidity pool, pending orders and stop losses waiting to be triggered. The existence of this liquidity pool above our identified demand zone strengthens the case for a potential price reversal at our point of interest. Waiting for confluence. Now that we have this confluence, a liquidity pool aligned with our demand zone, the next step is to patiently wait for price to sweep the liquidity below the equal lows and inducement area. Entry confirmation. Price has now successfully swept this liquidity pool and reached our point of interest, confirming the confluence we sought. Based on this confirmation and our market analysis, we can consider entering a trade here. Next step. To refine our entry, let's zoom into the 5-minute chart for a clearer view of price action and search for any signs of a change of character, CHOCH. 5-minute time frame analysis. On the 5-minute chart, we can clearly identify a change of character, CHOCH, as price breaks structure to the upside, leaving behind a notable inefficiency. This signals a potential shift in momentum favoring buyers. Additionally, we spot the order block formed by the chalk's wave, marking a significant point of interest for our trade. We also observe a VSR, violent swing rejection, pattern, which confirms a strong rejection from the higher time frame's demand zone. This pattern further validates our entry decision, increasing the probability of a successful long position. Trade setup and execution. With these confluences aligned, our confidence in this trade setup is high. We place a buy order at the identified point of interest. Our stop loss is positioned a few pips below the lowest point of the zone to maintain proper risk management. Our take profit target is set near the recent major 1-hour structure, a critical level where price is likely to reach. By clearly defining our entry, stop loss, and take profit, we establish a disciplined and well-planned trade. Trade outcome and advice. Once our buy order is triggered, we officially enter the market. As anticipated, price moves upward and reaches our take profit target, delivering a favorable 8-to-1 reward to risk ratio, a strong indication of a successful trade. Final thoughts. Remember, trading is not just about chasing profits, it's about managing risk, staying disciplined, and continually learning. Success requires patience, practice, and resilience. Don't get discouraged by losses. Instead, focus on improving your skills over time. Closing. Thanks for watching. I hope you found this analysis helpful and informative. Don't forget to subscribe and turn on notifications to stay updated with our latest videos. We value your feedback. Please leave your comments and let us know what topics you'd like us to cover next. Wishing you all the best on your trading journey. See you in the next episode.